talked about a lot of different subjects that affect the Treasury markets. One thing we haven't talked about are inflation expectations or lack thereof for the U.S. economy. I mean, we've been speaking a lot about that for China, but not for the U.S. Where do you weigh in?
That's right. Well, the Fed has been in play because of inflation coming down. And we think there's risk that inflation starts to move up a bit. But more from a longer-term perspective, we think the market should be pricing in much higher inflation risk premium. In the near term...
So pricing in for disinflation, so to speak.
That's right. That's right. In the near term, what we could see is inflation that the Fed just doesn't really care about. And that's coming from commodity price pressures. So you talked earlier about the potential for the bull run in the commodity markets to continue in 2011. At least some of that is likely to be filtered down to the consumer.
That's true. I mean, we did talk about how we actually did a poll at Bloomberg and asked a lot of investors and analysts and economists of what they thought about prices. And most do say, especially for the first half of the new year, we will see commodities prices go higher. We spoke with Ed Meir, though, earlier as well from MF Global. He says at some point there will be a correction. And he said at some point, for example, oil, at least in his view, he says, cannot go over $110 per barrel without destroying some demand. What do you make of that?
Well, first of all, we're still a ways away from 110, and we're seeing these price increases with a consumer that's starting to come back, and that's very important as far as the potential pass-through rates from commodities into consumer prices. So grocers, for example, have been having a bit of trouble so far this year passing on higher food prices to the consumer. But with the consumer starting to spend a bit more, as we've seen in the retail data that we've been getting so far, businesses should have a bit more pricing power, and we could see that come through in inflation.
Yeah, I mean, as you mentioned, the consumers, we've been surprised, I guess happily for retailers' point of view, with just how strong the U.S. consumer has been, especially during this holiday season. How do you feel like the average person, I know you look at all kinds of data, is actually doing with his or her deleveraging?
Well, I think what's important here is that the growth that we've seen over the past year, hasn't really been looked at as sustainable by the markets because it was being driven by fiscal spending, by inventory rebuilding, not really by the consumer. We're now seeing a turn in the data where the consumer has delevered enough and incomes are rising enough that spending seems to be on a pretty solid 2.5% to 3% track. That we think is enough to get businesses starting to hire again in a more meaningful fashion, and that could really spur a sustainable growth rate where businesses hire, consumers spend more because of greater incomes, which get businesses to hire even more. So a nice cyclical move in the economy.
So, Michael, before we let you go, let's put you on the spot here and get you to give us some facts and figures for the new year. Where do we finish with unemployment, for example, by the end of 2011?
End of 2011, we think that'll come down to around 8.6%, which is a far cry from 9.8 where we are now. But again, that's because we expect this pattern of businesses hiring to start up again.
And the Fed, you say, stays on hold for sure next year. QE3, you say, is a possibility, even though the market has started to discount that. Any other predictions you would like to make before we let you go, Michael?
Well, we think rates will move higher by the end of the next year, particularly at the longer end of the curve, so a steeper curve than what we see now. And we also expect that inflation expectations should be rising over time.
All right, you heard it here. Thank you very much, Michael Pond, joining us there. He is the co-head of interest rate strategy for Barclays.